Okay, now welcome to understanding the market correlations. Now, there's a couple of different types of correlations in the market, and this is understanding the correlations is a great way to, when you're looking at the market, like a page like this, the global markets dashboard, where you can see various things happening. I mean, we've got the currencies over here on the right-hand side, and you see various movements across those instruments, and you're thinking, well, okay, why are these ones down and these ones, and why are these up? And it's hard to sometimes work out what's going on. But let me just start with there's a couple of different layers of correlations, and what I was trying to get to is what we do is, even with the risk on or risk off sentiment, which is sort of evolved around the global financial crisis around 08, 09, we are looking for correlations in the market to sort of reduce the level of risk and give us the general idea of direction where it's coming from. Now, just going back to the global financial crisis, because the markets were discombobulating so much that what we used to, you did, instead of looking at the economic numbers and saying, okay, well, we've got some numbers here, are they strong or weak? And sort of looking at the outcomes associated with those, that wasn't the way the market was working. Like in this sort of scenario here, retail sales figures come out in Canada, okay, much worse than expected. The Canadian dollar goes down against everything, right? Against so dollar CAD goes up, and the CAD crosses all get hit. So that's sort of normal market conditions. But sometimes when the market discombobulates, and it does it reasonably regularly these days, we see something different happen. And like the economic data is released, then the market sits back and says, okay, well, let's see what happens with the equity markets before they even hit the currency markets. This is more around, complete discombobulations. Then this is where the risk on, risk off sentiment came from. Depending on what the market's interpretation of that data was, the equity markets would go, say, up, and then we would see Euro, Sterling, Aussie, Kiwi go up, and the dollar go down. And that's the sort of foundations for the risk on, risk off sentiment. And generally, in good market conditions, you'd love to see the yields, right, on the treasuries go down. Okay, lower interest rates leads to higher investment in the equity markets, and that drives the dollar lower. That lower interest rate scenario drives the dollar lower as well. So that's why the movement here, the dollar goes down on that risk on sentiment, because the general principle would be higher equity markets, lower interest rates, and then the currencies move according to that interest rate differential, which is if the yields are going down on the US treasuries, that means the US dollar has a lower value at that time, and Euro, Sterling, Aussie go up. Anyway, I'll get into that, because that's sort of like where we get to at the end of the day is understanding the correlation between the different markets, right? So let's just start it back at ground zero and looking at the correlations between the currencies. Now on this page here, it's my US dollar relative strength page, and I've got the US dollar lined up here as the base currency, right? Which is the first currency. So a lot like Euro, Sterling, Aussie, Kiwi, I've inverted them on this table. So the US dollar is the first currency. So I can actually sort of see what's going on with the US dollar, say on a daily percentage, month to date or year to date. So we can see how the dollar is performing against everything else. And I've got and then I've done the same thing here so I can see very clearly what the Aussie's doing against everything. And doing that enables me to see where the pressure points are, which crosses are doing better than others. But you know what, when we look at the general market itself, the general basic correlations come down just to the way the currencies are quoted. And it's almost a shame, right, that we don't have uniformity, sort of almost like Japan, right, with the Ichimoku cloud. Why can't they just, when you come down to the global or the major currency pairs, it would be easy if the euro, against the dollar, or if the US dollar was quoted the same way across all the instruments, right? Because then we would see very clearly, you wouldn't have to invert these four pairs, and we could just sort of see whether the dollar was going up or down. It's one of the weirdest things. And why is it quoted like this? Just historically, it was. Whereas, and then as a lot of other currencies came online, it was the US dollar is the base currency. So coming back to that, what can we do with that? So if basically depending on what is driving the various currencies, we can actually sort of see just with the correlations, just the way they are quoted in the market, they will either go up or down on their sentiment, right? So if we had a risk-off sentiment, right, and equities were going down, and the yields on the treasuries were going up. Now, let me just probably come back and just expand that, because then it's going to make it a little bit easier. I was going to do this at the end, but we can do this at the start. So when you come to the value of various currencies, it always comes back to the general interest rates is the driving force. Now, all the economic numbers that we look at, and we sort of trade some of these numbers, go towards the value or the future value of the interest rates in those currencies. Higher interest rate, higher currency value. So when it comes to the treasuries, and you see this a lot on the news services, if you're not familiar with this, right, you see sometimes like the bonds and the US treasuries, they move around here and there, just like the currencies do, the commodities, all the various instruments. But at certain stages, they become a focal point. And if they do become a focal point and the yields are going up very rapidly, well, that means higher interest rates in the US, right? If there's a situation of higher interest rates, well, the equity markets, right? It costs you more to invest. So there's usually a decline in the equity indices or equities in general. Okay, higher interest rates, higher borrowing costs. Okay, so people get out of their equity positions. That's the general basis of it. Now, with that higher higher yield, higher interest rate, right? That means the US dollar value of the US dollar is going up. So that's why we would see on the dollar pairs, the pairs where and let me just go back to this, the base and the terms currency. The base currency is the first currency in the quote. Now, dollar Swiss, dollar yen, dollar CAD, exactly the way we sort of say them, the dollar is the base currency. So if US treasuries are going up, it means higher interest rates in the US. Anything with the US dollar in it goes up. Now, just on the other side of it is we've got obviously euro, sterling, Aussie, Kiwi, where the euro against the US, sterling against the US, the US dollar is the terms currency. And just because the way they're quoted, these pairs will go down, right? So this is a very important correlation between the various financial markets that you just need to understand, right? Leonard, does that make sense to you?
Yes, it makes sense.
Yeah, cool. I mean, this isn't rocket science. We're just sort of basically going over things. I got that email out late, so I know some of the guys that were really keen on this will have to come back and watch the video. But at the same point, right? Let's just go back through this. If the US Treasury yields go down, the US dollar goes down because we've got lower interest rates in the US. So the pairs where the US dollar is quoted first go down, and the pairs where the US dollar is the terms go up. Once again, just because that's the way they are quoted against each other. Okay, so, and this sort of goes along the lines of what's happening with the other currencies. When it comes to the crosses, right? And say we're looking at euro, most of the euro, sterling, Aussie, Kiwi, the crosses are all quoted largely the same way, right? So when you see euro going up, you can see very clearly here. So these pairs should all basically correlate together because the euro is the base currency. And the same with the British pound, Aussie, and Kiwi, right? And actually most of the yen crosses there as well. Although I have flipped them upside down here just to give me an idea of what the yen is doing against those pairs. So it makes it easy correlation-wise if this is the key part to it, because say I'm looking at the euro and I see, well, euro against the dollar is going down, but euro's going up pretty much against everything else. It's flat against the sterling. So euro is actually doing quite well. It can lead you into where things are. Maybe you need to do some work here and find out what's going on. If euro's going down, but it's going up against all the crosses, well, then that's a US dollar event, which is impacting the markets. And what you can be simply doing by looking at the correlations, if you have a quick look here and you look at, I mean, you can easily do it looking over here. You'll see euro, sterling, Aussie, Kiwi all doing the same thing. But sometimes those major instruments will be all lining up, right? They do correlate because they're all against the dollar. And then you get some discombobulation around some of the crosses on other instruments. So basically, understanding the correlations, like you should be thinking here, well, if euro's going up against everything, why is it not going up against the Aussie? Okay, that can lead you into going over, finding out what's going on euro, Aussie, and working out, is there a trading opportunity here? Is there a mismatch? Or is there something else in particular happening? But you don't have to dig too deep around the correlations, right? Because the basis of it is basically around how instruments are quoted against each other. If they're all against the US dollar, well, it makes it easy to work out what's correlating with what. And the key part to, say, looking at the major currency pairs, okay, and the top four pairs, as we know, are quoted with the US dollar as the terms, the bottom pairs as the base. So they go in different directions. And understanding the correlations is important, because if you see these pairs here, especially the pairs that correlate going up or down and like discombobulating, same with the dollar pairs, well, you know that we've got tricky market conditions. And that to me would be like a bit of a risk alert, right? If these, and at the same time, if these, say, four pairs at the top here are all going up or all going down, I get confidence from that, and I understand that there's market uniformity, right? So trading the correlations is one thing, and I'll come into that next, but just understanding the correlations can lead you into good trading conditions or identifying, probably higher risk trading conditions. Okay, so that's what we're looking for, the correlations. Now, trading the correlations. Now, I can tell you that, and when we look at and you can see this a little bit better on the charts, when we see, and this is why I line the charts up based off their correlations. So, I've got the dollar index there as a general sort of parameter of what's going on in the dollar. Understanding that the euro is 58% of the basket. It's like a counter, like an offset move of the euro, pretty much. But the dollar pairs are at the top here, right? I like to see what the dollar's doing, Swiss, yen, and CAD. And let me just change this one here. If I've got the euro, sterling, Aussie, and Kiwi all lined up at the bottom. So the orange pairs, they all correlate together, or they should. And the dollar pairs at the top, the pink ones, they should be moving together as well. Now, once again, what we can do, like you can look at these markets here, you see euro sort of drifting lower down through the trend line. We've still got this support level. Like the Fed cuts haven't gone away. So, but the market's just been a little bit cleaned out. I still think the dollar will run before the other pairs. It's a bit of a race to the bottom at this stage. And then you see Aussie and Kiwi going lower, right? And so you see very similar. So there's two types of correlations in say the currencies, right? And it's easier to refer to where they are geographically. Like these bottom four pairs, let me just get a light of color there. You got euro, sterling, Aussie, and Kiwi, right? They correlate together because they are all quoted the same way against the dollar. But then there's a tighter correlation, and that's just geographically, right? These two have very similar economies, euro and Europe, as do Aussie and Kiwi. So euro and sterling correlate like 97% of the time, as do Aussie and Kiwi, right? You'd be putting it somewhere around there. It's that tight. But when you come into looking at, say, the four of them, right, they are all quoted the same way. It comes back down to about 90% of the time, right? So you can't hang your shirt on, I'll get long Aussie, unless the correlation is tight if euro's going up. So sometimes understanding the correlations, and let me just give you a couple of hypotheticals here. Say the ECB came out and did a surprise rate hike. This euro goes up, okay? Now, euro against the dollar. That means the dollar is going down and the dollar index would be going down. And for no fault of their own, sterling, Aussie, and Kiwi will start going up as well, because that's the way they are correlated, unless there's a significant event in those separate countries that stops the correlation from working. So what you can do is sometimes where the major move is occurring, say it's in euro and it's a surprise event, this thing is shooting up and there's no liquidity. It's very hard to get into the trade. There will be a lag with its other correlating buddies around what's going on there. So euro might have already gone. Sterling might start to go. You might be looking at Aussie and Kiwi going, these things haven't gone yet. You can start to anticipate a trading opportunity on these pairs, especially if we've got technical levels where it breaks through and then takes off around the move on euro. So the move might be in euro, but we end up trading, say, the Aussie or Kiwi based on the euro move. Okay, so that's the sort of luxury you can have. So when I see major significant events, more often than not, it's in the US dollar. That impacts all the various instruments. You can quickly have a look, right? So if I, once again, say hypothetically, there's a big upside move in the dollar, well, I would be looking to see if the dollar pairs have actually moved higher yet. If they haven't, well, then we've got a potential trading opportunity there. Okay. At the same time, if euro, sterling, Aussie, and Kiwi, if they haven't started moving lower yet, or maybe one or two of them have, then you can expect the others to play catch up at some stage, and there's a trading opportunity there. So just understand the way the correlations are, it can actually open the door for trading opportunities in other instruments besides the one that is mainly impacted, which more often than not can have very wild price action and say no trend lines, and you can't see what's going on. So if you see an instrument, say, shooting up like the dollar, well, if we've got support trend lines like here in euro, like I could be quickly having a look here and going, well, I've got euro, sterling, Aussie, Kiwi here, but you know what? Euro's the only one with a really good support trend line. That's the one you get onto, right? And I'll be focusing very closely on this level. If the dollar kept on going, I'm into a trade here on euro based off basically the correlation or the way the correlations are. In this one, it's an inverse correlation as opposed to, or a negative correlation as opposed to a positive correlation. All right. So that's the thing, right? So just understanding how these things move because of the way they're quoted can not only show you good trading conditions, it can also lead to, and this is why we look at the majors and I line them up like this to make sure we can see the correlations, right? Good conditions. Okay, we're looking for trading opportunities. If one of the instruments is taken off, like say the euro, I'm looking at sterling, Aussie or Kiwi, or say on the other side of it, dollar Swiss in particular, out of those pairs. The CAD and dollar yen can sort of often do some other crazy stuff. Like the correlation, and I'll come into the correlation with CAD in a second because it's got such a close connection with oil, it deserves its own sort of topic, but it can lead into, okay, euro's gone. Is there a chance here on sterling, Aussie, Kiwi, or Swiss? Do we have trend lines in play? And then you can sort of pick up some nice, easy pips, some nice easy cash on these other pairs, because you know what the correlations are. You've missed the main move on the main event, but it still leaves the door open for the other ones because they will lag behind that move. But once they lag, there's a period, especially if they go through trend lines, where they will accelerate and catch up to the move of the main trading instrument. Okay. Now, let's just have a look at dollar CAD, because it is its own unique thing, right? And when we look at the CAD, it is and I've just got the oil here as a line chart as opposed to the bar, just to make it a little bit easier to see what's going on. Now, the relationship between commodities and currencies is a real thing, right? You look at, and that's why we call dollar CAD Aussie and Kiwi. Aussie and Kiwi, especially the Aussie, massive iron ore, massive uranium, which will be a thing in the future, and it already has been. Gold, and for dollar CAD, oil is a major beneficiary of Canada, right? Big part of their GDP and their whole basic income streams in Canada are huge around commodities. So you've got that's why we call Aussie, Kiwi, and CAD the commodity currencies. If the commodities are getting hit, you can be sure that the Aussie, Kiwi, and CAD are getting hit, right? This isn't a relationship with commodities. But when we sort of drill into it, we can drill a little bit firmer into dollar CAD, because oil is such a major part of their economy. Okay, so what we do with that, and this is just once again understanding how these things are quoted. It's obviously the major is dollar CAD, right? So the CAD is the second part of the quote. That means with oil over here on the left-hand side, I've got to invert the range there, the value, right? So just to reflect, because the Canadian dollar is the second part of the quote. So if dollar CAD goes up, right, then the Canadian dollar goes down. And that's because the Canadian dollar is weakening. But if oil goes to the downside, right, dollar CAD is going to go down. Let me just clear that screen. If the price of oil rallies, okay, so going down means it's getting stronger, then the value of dollar CAD will go down, right? Because the oil goes up, so CAD goes up, dollar CAD down. So you basically follow the trail here a lot closer, just basically off the correlations. This makes trading dollar CAD trickier than most of the majors, because you've got three things to consider. Okay, potentially the economic data out of Canada, out of the US, and you always factor in oil. See how oil is falling here, right? The green line, it is driving dollar CAD higher, and that is, nothing else seems to be going on, right? So when the dollar starts trading sideways, when you're looking at the correlations, and you can see everything's sort of neutralized, Aussie and Kiwi are getting hit because of their correlation with China. China's economic activity and growth is directly correlated with Aussie and Kiwi. And that's because China is their biggest export market for everything. Okay, so if China starts to tank, this is a positive relationship between China, Aussie, and Kiwi in particular. China tanks, Aussie and Kiwi tank. China rallies, Aussie and Kiwi rally. So there's country correlations, there's commodity correlations, then there's the general correlations between various instruments, especially just the way they're quoted, the currencies. And then you've got the other correlations, so this is where it's sort of, I know it gets a little bit expansive, but if you can just sort of put this together, then you've got the various financial market correlations. And I was just going through this before. Basically, it's just a dollar play, right? Yields go up, dollar goes up, Euro, Sterling, Aussie, Kiwi go down, and equities go down. That's the natural relationship between the bonds, equities. Okay, you could say interest rates because bonds are a direct relationship there. or a direct reflection. Bonds, currencies, equities. If you understand that, you're going to be in good stead. Now, and then you've got, say, dollar CAD, a massive correlation with oil. Then you've got, say, Aussie and Kiwi, massive correlation with China, right? As well as commodities. So you can start to see how the correlations can start to get a little bit messy, because you've got, like, there's various things that are going on right now, right? So Euro, Sterling, Aussie, Kiwi all correlate just on the way they're quoted. But Aussie is going down, and so is Kiwi, because China's tanking. But these ones don't have a relationship with China, so they go sideways, right? So the point of that is, of explaining that is, if you just sit there and trade the correlations without sort of having a look around what's going on, you can run into mistakes, right? You might be thinking, well, Brad's actually told me Aussie, Kiwi correlate with Euro and Sterling. Well, I'm going to sell Euro and Sterling. Well, at this point, it's not going to impact, because where the direction or the correlation that's impacting Aussie and Kiwi doesn't impact Euro and Sterling as such. And almost understanding the big brother setup here, right? If you look at these four pairs, yeah, they do correlate the same because they are all quoted against the dollar the same, but the Euro is the big brother. Sterling is right behind it. And then you got the little, like, step brothers, Aussie and Kiwi. So if Euro is going down, right, against the dollar, then Sterling's more often than not going down, and then you'll have Aussie and Kiwi tagging along. If we see Aussie and Kiwi going lower, they will have a small impact on Euro and Sterling, as opposed to the other way around, right? So there's some instruments have a bigger impact on other ones. And it's just because of the sheer volume of Euro. It's harder to get Euro moving on the back of, say, weak Aussie employment numbers, because it's, you know what, the market's a bit bigger. Okay, so these are the sort of natural correlations. And when we start to come in and have a look at, this is why it's good to look at your sort of news and see what's going on across various things. The easiest correlations to look at are the yen, right? The yen crosses, or even the yen. Well, actually, let's just get up the what I would sort of call the major yen crosses. Okay, so these ones here are great to be looking at, and I tell you what, heavily underutilized. And that's, like, it has been of late, because, you know, dollar yen has just been in a box. Whereas a lot of these other pairs, they all work together. So, you know what, when we're looking for trading opportunities here on dollar yen, and you can sort of see here, even with the latest movements in dollar yen, right, we're starting to see, like, this largely sideways, right? Now, Aussie and Kiwi are starting to move a little bit lower, because the impact of China on the Aussie and Kiwi value is impacted across all the crosses on those two instruments. But if you look across Euro yen, Sterling yen, Swiss yen, nothing's going anywhere. If anything, the markets are getting chopped up, the Asian traders. It's up and down through the cloud. But you can be sure as hell, when this thing goes, it is game on, right? What I'm talking about there, when dollar yen moves, the crosses, let me just come into the dailies, it moves across all of them all at the same time. And this is the best one to be getting onto if you have missed an opportunity. Well, you can come back through here and get one of the other ones. And this is sort of what I was sort of talking about. If Euro was going up, look at Sterling, Aussie, Kiwi, or Swiss very closely, and you can get onto those. But you need to know how to trade them because of the way they're quoted. Now, this correlation, because they're all quoted the same way, it becomes super simple, right? All you're looking for is, say, like, okay, you can see a big impact here. Why is Kiwi move further than others? It's breaking down through the cloud, right? Aussie is at the top of the cloud. You're getting a move here, CAD yen. Okay, oil is falling, right? So that means CAD yen falls, the natural correlation with oil. Okay, Canada, lots of oil. The yen, Japan, no oil, right? So if oil value goes down, CAD yen goes up. If oil value goes up, CAD yen goes up, right? Natural correlation. So you're looking at these pairs at the top and you're like, okay, I understand the correlations here. I understand also that Aussie correlates with China, as does the Kiwi, very closely. So I can see why they're lower. But the big guys, they haven't moved yet, right? And we are waiting for these things to tumble, because when they do, these three will move at once. And this is the luxury of understanding the correlations, right? If euro tanked first and sterling or Swiss yen hadn't moved, I would definitely be placing trades on these two if they haven't broken through the cloud yet, right? Just because I know with the correlations, these things will catch up with the major move if it was on euro yen. Now, what happens a lot is what happens if it's a yen move? Well, unfortunately, I mean, this is the thing, like they can all break the cloud at different times, but if it's a yen move, right? Say Japan raises rates on the 31st of July, which there's a chance of it. Well, all of these will move at once, right? Now, do we get a chance to get in? Well, you might if you're quick, or what I would be doing, and this is why trading the yen, and this is why trading FX in Japan is so epic, so massive, why everyone does it. It's because it's an easy sort of framework. You could be placing pending orders here on these pairs, and this is really important coming up to, say, Japan raises interest rates, right? Higher interest rates. It'd be great to see the value of yen will go through the roof. We're coming up to a Fed cutting cycle, right? So that means, yep, yen goes up, dollar down. So we should see a move across the board here on a lot of these pairs. Okay, so the yen, understanding the correlations when you look at the yen crosses is super cool, right? And this is why it's a shame, as I was saying, that the global market hasn't got uniformity here with Swiss, yen, CAD, with the bottom pairs here, because if they were all quoted the same way, we could be looking at the exact same charts and just looking at the impact of the dollar. Quite often we're looking at charts, euros down, dollar Swiss is up, dollar yen's up. So you've got to just have your wits about you. You can't just be getting long or short every other pair because they correlate differently. Okay. Now, Leonard, have I missed anything there that you have questions about?
No.
I mean, this is really a bit of a rehash, catch up on what is what. But if you can just understand these, it may lead to questions going forward. So if you see opportunities, right, as I was sort of just explaining, even on the pairs. So I'll just sort of run through this just to finish up. Like you got the pairs that just correlate because the way they are quoted, right? And it's the way we set them up on the charts, so we can see if the dollar's going up or down according to the correlations. It makes you're confident that the trading opportunity is good, or maybe I should reduce my risk, or you know what, I should stay away. And that's exactly why we've got the markets, the global dashboard here lined up exactly the way it is. So I can see these top four pairs, if they're going up, these other ones should be going down. And that gives me confidence in those markets. Now, with the connection with the market, the bonds and interest rates, if the yields go up, right, means US interest rates are going up, means lower equity indices, okay, higher cost of borrowing. So your equities go down, and with that higher dollar, right, you get the dollar move, which is, let me just get my little orange pen up here. Okay, the dollar would be going up and euro, sterling, Aussie down, and vice versa. Dollar CAD, very closely correlating with oil, so you got to factor that in. The Aussie and Kiwi, very close correlation with the Chinese economy and economic conditions. Very important there. Euro and sterling, well, they correlate very closely together as well. And this is where we've seen a bit of disparity, but because obviously the UK is out of the EU now, as far as like a monetary system. Any geopoliticals in Europe will see euro go down generally and sterling go up. That's the break in the correlation there. The other one is just on, I haven't really touched on it much, and you probably sort of get it because when I look at the equity markets, the US equity markets are the epicenter. Now, generally speaking, these equity markets all correlate. If US equity futures are going up, so are the Asian equity futures and so are the European ones. They generally correlate together unless there's a specific event in those locations that changes the correlation. So that can make you confident if you are trading equities, right? So currencies correlate, equity markets correlate, even the commodities correlate, right? So the general groups within each financial market have a close correlation depending on the way they're quoted. Equity indices are all the same, so they correlate the same way. Most of the commodities are quoted with the dollar as the same way, so they all correlate. So what you can do is you can actually start to pick off instruments that either haven't moved or focus on them if they have moved extremely against the other instruments because something's out of whack. And a lot of moves you will see very, you can see discombobulations in these correlations. So just be careful. You don't just sort of run into it and go, all right, I'll get long euro because sterling's going up, right? You can come back and do a cross check. Understanding the way the correlations work can lead you into going to find the answer because if that goes up, this should be going up. So I can actually work out what we're trying to find every day is what is the raw nerve, right? Because if you understand where market direction is coming from, you've got the advantage in the market. And it's usually only there for 24 to 36 hours. It can be quite often the US Treasury market, right? If you know it's coming from here, well, you know what the impact's going to be on the currencies and the equities. And you can get positions on quickly enough to take advantage of those, right? But once that correlation ends, you've got to be quick to sort of recognize that and get out of those trades and then come back to trying to identify normal market conditions again. All right. So there's a bit in that. And this is why it gives you some understanding as to why we set up this screener the way we have or the way we do. And it allows us to see, what's going on in the equity markets. Okay. Got the bond markets down here as well, currencies and commodities. Okay. And then you obviously go into the separate currencies over here. All right. Well, that's a bit of a run through understanding the market correlations. If you have any questions based off this video, and I know a lot of guys missed it, so I would expect quite a few questions. If need be, we can come back and revisit this one because it's just and I know I go through it because it's such a simple thing that I've been trained in like 30 years ago. So it's just a natural thing for me. If I've been a little bit blasé sort of explaining things, just let me know because I can sort of dig a bit deeper and explain things a little bit in more detail if you need that detail. All right. Well, thanks for joining us. I'll get this up online. We do have I really want to show you what's coming up here on the website. It should be hopefully done this week, and you guys will get some clues as to like where these correlations are going, a whole range of things. This should be online by the end of this week, and I'll run through some stuff on that. Anyway, thanks for joining us, and we'll catch up with you soon enough.
Thanks, Brad. You have a good day.
Thanks, Leonard. Cheers, mate.